Listen, I'm going to tell you something right now that's going to separate you from the financial slaughterhouse. And if you don't pay attention, you're going to wake up one morning and realize half your net worth just evaporated while you were sleeping. I've been in this game for decades, and what I'm about to share with you is the single most important warning you'll hear in 2026. You think your real estate is safe because it's tangible. You think your crypto is the future. You think your tech stocks are too big to fail. Let me tell you something that will keep you up at night. In January 2026, we watched silver, an asset class that has held value for 5,000 years, crash over 30% in roughly 30 hours. 30 hours. That's faster than you can transfer money out of your brokerage account. That's faster than you can call your financial advisor. That's faster than most people can even process what's happening. And I'm here to tell you that was not an isolated event. That was a dress rehearsal for what's coming for every single over-leveraged, overhyped, overvalued asset on the planet. Now, I need you to understand something fundamental about how I've learned to see these things coming. I've sat through the dot-com incineration where people lost everything on companies that were supposed to change the world. I watched the 2008 housing crash where people's biggest asset, their home, became their biggest liability overnight. I've seen crypto winters where so-called revolutionary digital assets lost 80% of their value and never came back. And through every single one of these events, I noticed the same pattern repeating itself like a sick joke that everyone forgets by the time the next bubble forms. The pattern is simple. Asset goes up, people get greedy, leverage gets piled on, fundamentals stop mattering. And then something small, something seemingly insignificant triggers the dominoes. In January 2026, that trigger was a Fed nomination announcement. One announcement, one name, Kevin Warsh. And suddenly, $40 billion in precious metals markets just vanished. Not transferred, not redistributed, vanished, wiped out, gone. And the people holding the bags weren't the institutions. It wasn't the hedge funds. It was the retail investors, the people watching YouTube videos, the people who thought they were being smart by diversifying into hard assets. They got destroyed because they didn't understand that in today's market, the crash doesn't give you warning. It doesn't send you a letter. It doesn't let you exit gracefully. It just hits you like a freight train while you're asleep. Here's what nobody is telling you about that silver crash that should terrify you about your own portfolio. The crash wasn't driven by supply and demand. The physical silver market is still in deficit for the 6th straight year. We're using more silver than we're producing. The fundamentals, the things that actually matter for long-term value, they were actually bullish. But here's the trap. The price you see on your screen, the one that determines whether you're up or down for the day, that's not determined by physical supply and demand. That's determined by the paper market, the futures contracts, the derivatives, the leverage. And in that paper market, you can create infinite supply with the click of a button. You can sell contracts for silver you don't own, multiply that by millions of contracts, and suddenly you have a market that's completely disconnected from reality. When the margin calls started hitting, when the exchanges raised requirements from 10% to 15%, all those leverage positions had to be closed. And when everyone rushes for the exit at the same time, prices don't just correct, they collapse, they implode. They go into a death spiral where the price falls so fast that stop losses don't trigger, limit orders don't fill, and you're left watching your account get liquidated at prices you never thought possible. And here's the part that should make you sick. This same dynamic exists in almost every asset class you own right now. I'm going to break down exactly why this is coming for your portfolio, and I'm going to do it in a way that your financial advisor won't because he wants to keep collecting his fees. First, let's talk about real estate because that's where most people have their largest concentration of wealth. You look at your house and you think it's real, it's tangible, I can live in it. They can't take that away. And you're right, but here's what you're missing. The value of your house, the number that determines your equity, your ability to refinance, your ability to sell, That's determined by a market that's completely drunk on cheap money and leverage. We've had 15 years of near zero interest rates, 15 years of people borrowing money at basically no cost. And what happens when you make money free? People borrow infinite amounts of it. They buy houses at prices that make no sense based on income. They buy second homes. They buy investment properties. They leverage themselves to the absolute maximum because the monthly payment looks affordable when rates are 2%. But here's the trap. Those low rates allowed people to buy at prices that are completely unsustainable based on actual cash flows. I'm talking about rental properties that lose money every single month. I'm talking about houses that cost 7 times annual income when historically it was 3 times. I'm talking about commercial real estate where office buildings are sitting 30% empty, but the valuations haven't adjusted because nobody wants to mark them to market. And you know what's going to trigger that collapse? It could be anything. It could be a jobs report that shows weakness. It could be a credit rating downgrade on some major city. It could be a regional bank failing because their commercial real estate loans are going bad. But when it happens, it's going to happen the same way silver crashed, not slowly, not gradually, violently. Because here's what the real estate bulls don't want you to understand. There's massive leverage in the system. People buying properties with 5% down, people with adjustable rate mortgages that are about to reset, people who stretched every dollar to get into a house and have no cushion whatsoever. And when prices start to dip just a little bit, the forced selling begins. One person has to sell because they lost their job. Then the neighbor sees that sale price and panics. Then the bank starts tightening lending standards. Then the next buyer can't get financing. And suddenly you have a cascade where prices don't correct 10%, they correct 30% because there are no buyers and everyone's trying to sell at the same time. That's not a prediction. That's just math. That's just what happens when you combine high prices, high leverage, and a catalyst. And right now we have all three in spades. Now let me talk about crypto, because this is where the retail slaughter is going to be absolutely biblical. I'm not here to tell you crypto is going to zero. I'm not here to tell you blockchain isn't transformative. What I'm telling you is that the way most people are playing it is going to get them destroyed. You've got people trading with 50-to-1 leverage on exchanges that aren't regulated, that aren't insured, that could disappear overnight with your money. You've got people buying meme coins based on tweets, based on Reddit threads, based on absolutely nothing. You've got people who think a coin is safe because it's been around for a few years. And here's what they don't understand. Crypto markets are even more vulnerable to the silver-style crash than commodities are because crypto has no intrinsic value. Zero. None. With silver, at least there's industrial demand. At least there's jewelry demand. At least there's some floor where physical buyers will step in. With crypto, if the narrative shifts, if the confidence breaks, if the leverage gets unwound, there's no floor, there's no bid, there's nothing. It can go to zero and stay at zero. And the leverage in crypto makes silver look like a savings account. People are trading with 100-to-1 leverage. A 1% move against them and they're wiped out. And when the margin calls start cascading, when the exchanges start liquidating positions, when the stable coins start breaking their pegs, you're going to see crashes that make 30% in one day look like a minor fluctuation. I'm talking about 50, 60, 70% in hours. And the people who get hurt aren't the whales. It's not the institutions. It's the retail traders who thought they were being smart, who thought they'd get out before the crash, who thought they were early to the party. They're the ones holding the bag when the music stops. And let me address what you're probably thinking right now, because I know how your mind works. You're sitting there thinking, but I'm diversified. I own some stocks, some bonds, some real estate, some crypto. I'm protected. Let me disabuse you of that notion right now. In a real liquidity crisis, correlations go to 1. Everything crashes together. We saw it in 2008. Stocks crashed, real estate crashed, commodities crashed, even supposedly safe assets like municipal bonds got crushed. Because when the system seizes up, when everyone needs cash at the same time, they sell whatever they can, not whatever they want to. They sell their winners to cover margin calls. They sell their losers to raise cash. They sell assets they believed in for years because they have no choice. And that selling feeds on itself. Prices fall. which triggers more margin calls, which triggers more selling, which triggers more price declines. It's a death spiral that doesn't stop until the leverage is completely wrung out of the system. And right now there's more leverage in the global financial system than there has ever been in human history. More debt, more derivatives, more synthetic exposure, more paper promises backed by nothing. The silver crash was just a small taste. That was one asset class in one market. Imagine that dynamic playing out simultaneously in stocks, bonds, real estate, crypto, and commodities. Imagine trying to find a place to hide when everything is on fire at the same time. That's not a doomsday scenario. That's a mathematical certainty based on the amount of leverage in the system. Now, let me tell you what the sophisticated players know that you don't. They know that these crashes are engineered. They're not accidents. They're not random market movements. They're calculated transfers of wealth from the uninformed to the informed. When the exchanges raised margin requirements on silver, they knew exactly what would happen. They knew the leveraged retail traders couldn't meet those requirements. They knew there would be forced liquidation. They knew prices would collapse. And who was on the other side of those trades? Who was buying when everyone else was forced to sell? The institutions, the hedge funds. The smart money that had been building cash positions waiting for exactly this moment. They didn't panic. They didn't sell. They sat there with dry powder and waited for the forced sellers to create prices that made no sense. And then they stepped in and bought everything at pennies on the dollar. That's how wealth is really created. Not by chasing momentum, not by buying what's going up, but by having capital ready when everyone else is forced to sell. The silver crash created millionaires. It just didn't create them among the people who were long silver. It created them among the people who were short, who were in cash, who had the discipline to wait. And this brings me to the most important lesson you'll ever learn about investing. The market's job is not to make you rich. The market's job is to transfer capital from the impatient to the patient. That's it. That's the whole game. Every bubble, every crash, every mania, every panic, it's all just a mechanism for moving money from people who can't control their emotions to people who can. The people who got wiped out in silver weren't stupid. They weren't unlucky. They were impatient. They saw an asset going up and they wanted in. They didn't want to miss out. They didn't want to be the one sitting on the sidelines while everyone else got rich. So they piled in, often with borrowed money, often at the very top, and then they watched in horror as it all evaporated. Meanwhile, the patient investors, the ones who had been waiting for years for this exact setup, they got rich. Not because they're smarter, not because they have better information, but because they have better emotional control. They understand that the biggest gains come not from buying what's going up, but from buying what's being forced down. So let me give you the specific rules for surviving what's coming. Rule number one, and this is non-negotiable, eliminate all leverage from your portfolio today. Not tomorrow, not next week, today. I don't care if you're making money on it. I don't care if it's been working. Leverage is what kills you in a crash. It's what turns a 30% decline into a 100% loss. It's what forces you to sell at the exact worst moment. If you're trading on margin, stop. If you're using options, stop. If you're in leveraged ETFs, get out. Just own the asset outright or don't own it at all. Rule number two, build a cash position that would embarrass your financial advisor. I'm talking about enough cash to live on for 2, maybe 3 years. I'm talking about cash in a boring bank account, not in the market, not in some high yield scheme, not in something that could have issues during a crisis. Just plain, simple FDIC insured cash. You're going to hear people tell you that cash is trash. You're going to hear about inflation eating your purchasing power. Ignore them. Cash isn't an investment. Cash is insurance. Cash is the ability to sleep at night when everything else is crashing. Cash is the ammunition you'll use to buy assets when they're 70% off. And when the crash comes, and it will come, you'll understand why cash was the most important position you ever held. Rule number three, own physical assets for the assets you want to hold long term. If you want gold, buy physical gold and store it yourself. If you want silver, buy physical silver and put it in a safe. If you want Bitcoin, and I'm not saying you should, but if you do, hold it in a cold wallet that you control, not on an exchange. The moment you trust a third party with your assets, you're exposed to their problems, you're exposed to their leverage, you're exposed to their mismanagement. When the next crisis hits, the exchanges are going to freeze withdrawals. The brokers are going to restrict trading. The banks are going to impose limits. And if your assets are with them, you're stuck. You can't sell, you can't move, you can't do anything. But if you hold the physical asset, if you control the private keys, if you have the actual metal in your possession, nobody can take that from you. Nobody can freeze it. Nobody can margin call it. It's yours, period. Now let me address the excuses I know you're making because I've heard them all before. You're sitting there thinking, but I'm young. I can take more risk. I need leverage to build wealth. Let me tell you something. Young people got destroyed in every single crash I've ever witnessed, not old people. Old people have been through this before. They have cash, they have experience, they have perspective. Young people think they're invincible. They think this time is different. They think they'll see it coming and get out in time. They never do. They always hold too long, too. They always get greedy. They always think one more day, one more week, one more month, and then it's too late. So no, being young doesn't protect you. If anything, it makes you more vulnerable because you haven't been burned yet. You haven't learned the visceral lesson of watching years of savings disappear in hours. You need to learn it from other people's mistakes because if you learn it from your own, it's going to cost you everything you have. And here's another excuse I hear constantly, but I'm diversified in different crypto projects. I have Bitcoin, Ethereum, Solana, some layer 2s. I'm protected. No, you're not. When crypto crashes, it all crashes together. Bitcoin leads, but everything follows. The correlations in crypto are even higher than in traditional markets because it's all driven by the same narrative, the same sentiment, the same liquidity conditions. When the leverage starts unwinding, everything gets sold. The good projects, the bad projects, the scams, the legitimate ones, it doesn't matter. The selling is indiscriminate. So no, owning 10 different cryptocurrencies is not diversification. It's just concentrating your risk in one highly correlated, highly volatile asset class. Real diversification means owning things that actually behave differently in different environments. It means owning some stocks, but also some bonds, some commodities, some cash, some real estate, and actually understanding how they interact. It means not assuming that because something has a different name, it has a different risk profile. The truth is, most people are going to ignore everything I just said. They're going to keep buying what's going up. They're going to keep using leverage because it's working right now. They're going to keep thinking they're smarter than everyone else. And when the crash comes, they're going to be the ones selling at the bottom to the people who listened, to the people who prepared, to the people who had cash ready. That's just how it works. That's how it's always worked. The majority is always wrong at the turning points. They're always most bullish at the exact top and most bearish at the exact bottom. And if you want to be in the minority that actually builds wealth, you have to do the opposite of what feels comfortable. You have to sell when everyone's greedy. You have to hold cash when everyone's chasing returns. You have to buy when everyone's panicking, and you have to have the emotional fortitude to stick to the plan even when it looks like you're wrong in the short term. So here's what I'm doing, and you can take it or leave it. I've been building cash for 2 years. I'm sitting on more liquidity than I've had in decades. I own physical gold and silver, not futures, not ETFs, not paper promises, actual metal that I can hold in my hand. I own businesses that generate cash flow regardless of what the economy does, businesses that people need, not businesses that people want. And I'm watching, I'm waiting, I'm patient because I know that sometime in the next 12 to 18 months, there's going to be a moment when some asset, maybe real estate, maybe crypto, maybe stocks, gets cut in half for no good reason. A moment when the forced sellers are desperate and the buyers have disappeared. A moment when everyone's saying it's different this time, it's going to keep going down, it's the end of the world. And at that moment, I'm going to start buying. Not everything at once, not with reckless abandon, but carefully, systematically taking advantage of prices that make no sense based on any rational analysis. That's how generational wealth is built. Not by getting in early on the next big thing. Not by timing the market perfectly, but by having the discipline to wait for the fat pitch and the courage to swing when everyone else is frozen in fear. You have a choice to make right now. You can keep doing what you're doing, hoping that this time is different, hoping that you'll see the crash coming and get out in time. Or you can admit that you don't know when it's coming, that you can't predict the trigger, that you're not smarter than the market, and you can position yourself to survive and thrive regardless. One path leads to the same outcome most investors get, which is watching their wealth get transferred to someone else when they least expect it. The other path leads to the kind of financial independence that comes from understanding how the game really works and refusing to play it on anyone's terms but your own. I've made my choice. I've made it decades ago, and it served me well through every crash, every panic, every meltdown I've ever witnessed. The question is, do you have the discipline to make the same choice, or are you going to learn this lesson the hard way like everyone else? This is the moment where most people tune out because what I'm saying makes them uncomfortable. It forces them to confront the possibility that their financial plan is built on sand. It forces them to admit that they've been gambling, not investing. And that's fine. I'm not here to be popular. I'm not here to get likes and shares. I'm here to tell you the truth, whether you want to hear it or not. The silver crash was a warning. It was a message written in $40 billion of destroyed value. The message was simple. The system is fragile. The leverage is extreme. The crash will be violent. And if you're not prepared, you will be the victim. You can ignore that message and hope for the best. Or you can act on it and position yourself for what's coming. The choice is yours. But remember this when the next crash hits. Remember that someone told you exactly what was coming. Remember that you had the information and chose to ignore it. And as you're watching your portfolio get cut in half, remember that it didn't have to be this way. You could have prepared. You could have been patient. You could have been one of the buyers instead of one of the sellers, but you chose not to. And that choice has a price. Make sure you're willing to pay it. If you've made it this far, it means you're in the small minority who actually wants to hear the truth. It means you're serious about protecting your wealth, not just chasing the next hot tip. And that's exactly the kind of person I want in this community. So here's what I need you to do. Hit that subscribe button right now, not because I need the numbers, but because you need to commit. You need to make a statement to yourself that you're done with the entertainment, done with the hype, done with the get-rich-quick nonsense. You're here for the truth, and you're willing to hear it even when it hurts. And turn on notifications so you don't miss the next warning. Because trust me, there will be more. The cracks in this system are spreading, and I'm going to be here pointing them out, whether anyone wants to hear it or not. Subscribe now. Join the minority who actually build wealth, and let's get to work protecting what's yours.